All right, folks, in this update, we're going to be talking about the institutions confirming that they're getting ready to move tens of trillions of dollars through this digital asset space and this technology. But before they do, they had to get their ducks in a row. But the confirmation that they do have plans is all that we need to hear, right? And I know that we're getting impatient. I know we want it today. But today, I'll let you know before we get started that we do have a 2-for-1 special on XRP running right now. That's right, folks. It is still at 50 cents and just below, actually, right at about 49 cents right now. After you pay that premium to the exchange, you're probably going to be at about 50 cents. That 2-for-1 special is live. Now, another special is silver. That is sub $30 per ounce right now. We saw this thing just go back up to $32 for one of these buckaroos, and we're sub 30 right now. So take advantage of that while it lasts. And I know we want to see it now. I know we want to see tens of trillions on ledger today. It's a very slow moving process, but this is the financial system. It doesn't happen overnight, but I think that we're going to look back and be telling our children and our grandchildren just how quickly things actually did move along. But while we were living it, while we were in the middle of this thing, the agonizing pain of seeing how slow it seemingly is moving right now made so many people hop off the train, say, okay, this train's moving, but it's not moving fast enough. Let me get off. And I think that this is what you're going to be seeing right now in across not just XRP, other utility assets. And we're talking about the precious metals, and we're talking about just sticking to a business that might not be the most sexy thing, right? But that business pays the bills. We got a fly-by-night mentality, a instant gratification mentality in this generation. We want it today. We want it now. Well, this is the financial system that we're talking about, and that's just not how this works. So we're going to get into that later in the show. To get started, though, I wanted to hone in on some data points here in our economy. First thing, though, current events. We have thousands, and the current tally that's being reported is actually 75,000 pro-Palestine protesters and activists are lighting off smoke bombs and flares as they plan to surround the White House. So we're watching right now images coming out of that area of them vandalizing statues, monuments, and some activity taking place that's definitely interesting. We will be praying for peace and order in that situation over there. But a big deal taking place right now. We'll continue to observe that. Into our economy, you can't make this up, from the Kobesi letter. The difference between the headline jobs numbers and the household survey hit 4.1 million in May, the largest difference in history. Now, this is the difference between the household and the headline when it comes to jobs. And it's similar to CPI. You got core CPI, you got super core. And what they do is to just continue to strip out the things that are not favorable to their bias and what they're trying to achieve by making us feel like inflation's not running too hot. So core strips out food and energy, super core strips out food, energy, housing, and insurance and a couple other things like absolute necessities, but they strip it out anyways, right? Well, same thing's taking place right now with the headline jobs numbers versus the household survey, which is a 4.1 million discrepancy, largest in history. The household survey is important because workers are only counted once, even if they hold more than one job. And this is why they're touting such strong jobs numbers, as folks are having to get 2 or 3 jobs to pay the bills, or 2 to 3 jobs to replace them being laid off from that full-time, nice, high-paying job. This data shows that over the last 6 months, 1 million Americans have become unemployed. The number of people working multiple jobs in the U.S. hit a near record high of 8.4 million in May of 2024. Many Americans are now working multiple jobs in an effort to fight inflation. How is this a strong economy? Well, as we've been saying, it's not so strong. And when we understand how to decode this data, you can really see what's taking place. A record 9.3 trillion U.S. federal debt will mature and must be refinanced at higher interest rates over the next 12 months. This is the problem with our national debt, right? This debt expires, these bonds expires, they need to be renewed. New bonds need to be issued. And who's going to buy this crap? This is up by a massive 4.7 trillion or 102% in just 4 years. This comes as the US Treasury switches to issuing shorter dated maturity bonds with lower interest. As a result, a record 33% of debt outstanding has a maturity of less than a year. Meanwhile, the Fed has dumped 1.3 trillion of treasuries off of its balance sheet in 2 years, while foreign government demand for U.S. bonds has declined. Who is going to fund all this debt? Or, as I've been simply saying, who's going to buy this crap? Right? I like to simplify it and make it easy for us all to understand who's going to buy this crap, right? And we're going to continue right here. The last time full-time employment declined for 4 consecutive months or experienced over 3 million jobs losses was during a previous recession, or was during previous recessions, I should say. This one from Tavi Costa. To clarify, I don't believe we are currently in a recession. I disagree. Not by the textbook definition of a recession, but I do believe that we are in a contraction. However, if the Fed is looking for signs of weakness in the labor market to justify cutting rates without appearing desperate due to rising interest payments, and that's the debt that we're talking about needing to be renewed, that's that interest payments now outpace defense spending, right? And other political pressures, there are plenty of reasons to consider. So that headline unemployment rate did hit 4%. So that's something that we're going to be watching. But as far as the change in thousands of persons, that's what this chart is showing you. The last time that we had 4 consecutive months of full-time employment decline or over 3 million job losses was during previous recessions. Here's your recession in 2020. Here's your recession, the Great Financial Crisis, and there's the tech bust, and you can see that which direction we are heading right now. Right? You can see where this is going. It is not pretty, and folks want to debate: do we have a recession or not? How can we have a recession? Market's at all-time high. How can we be in a recession? I still have equity in my house. Well, go try to sell that house for what you think it's worth. Go see if you can get that Zestimate for your house. You got investment property? Let's see if you can continue raising rents on your tenant, or if there's some new supply coming online, making that market a little bit more competitive. Now, obviously, in real estate, some markets are still going up. I've talked about this in my real estate updates. You got to take it by a location basis, and you got to understand the segment of real estate that you've invested in. But broadly speaking, right, Americans are being duped. They're being lied to, and they're asleep at the wheel because they're getting their 401k statement and it's still doing all right. A little bit of a haircut. The 60-40 portfolio had its 3rd worst year in history, but it's still doing all right compared to where we were, right? A little bit of a correction after you've gone up multiples. A little bit of a correction, you still feel like you're doing all right. You still got a job for now. You still feel like you're doing all right. But this data point that I'm going to show you next, to me, I think really highlights where we're at in this cycle. And that would be credit card debt from consumers. U.S. consumers have added $3.4 trillion in debt since 2020, bringing the total to a record $17.7 trillion. Credit card debt alone is up by about $400 billion during this period and reached a record of $1.3 trillion in Q1 2024. This is at twice the pace than in the 4-year run-up to the 2008 Great Financial Crisis. Folks ask, is this time different? And I say, well, yes, it's a whole heck of a lot worse, right? At the same time, interest rate of this debt has spiked from 16% to 23%. We have some credit cards where you're going to be paying 25% or more interest. This puts credit card debt rates at a record high, which is triggering a rapid surge in delinquencies. Credit card debt is our next crisis, and this is why I think that we've can officially say that we've started to go into a contraction, is because credit card debt is no longer growing. Right? This just continued up and up and up through the past few years. Right? We added $3.4 trillion in debt total since 2020. $400 billion of that being credit card debt. That's rolling over. The annual interest rate has kind of flatlined slightly and rolled over just since the Fed stopped raising rates and they've paused them. But you can see now that the consumer credit outstanding amount revolving is starting to peak and it's starting to roll over there. So, whether or not we are going to hit the technical definition of a recession this year, I don't need to see that. It's like the video I just made this morning, the one of the train driving by. And I say, It's like the Saudi Arabia deal too. I don't need to see Saudi Arabia rip up the petrodollar agreement to know that they're trading outside the US dollar, to know that they're dropping our treasuries, to know that they're exploring DLT solutions outside of US dollar trade. I don't need to, see the train leaving the station. I already know just off of the data that we're recording and the pre-allocation contracts and the central banks buying more gold than they have in the past 50 plus years. By the time you wait for them to admit and for the data to admit that we're in a recession, we're already going to be well into it. And this is a problem on the data lagging. The data lags, which gives the statisticians some time to cover their basis, make their revisions. And it's just like we got with the GDP on Q1 this year. GDP, huge contraction from positive of over basically 3% to now down to 1.6. But the revision came back in, it actually was only 1.3. So it was even worse than the initial reading. Does mainstream media come back and correct that revision? No. Oh, God, no. God, no. They don't come back and cover that up. The market's already moved on to the next thing that's going to pump it up. And this is why I think that the average person's getting set up to see a huge correction. And this is going to hit the 401ks. This is going to hit our real estate. It already is right now. It's being confirmed in the data in real time. So let's make sure we get you guys tapped in. Make sure you guys stay part of this community where I'm talking about this stuff on a daily basis, figuring out how we can decode the data and position ourselves accordingly in our business and investments. When it comes to our investments, let's talk cryptocurrency, what you guys love to talk about, what my number one investment is in this digital asset space, focused on XRP. And there's an interesting thing that's taking place. I'm going to play two clips here. One is from the CEO of the Dubai Blockchain Center. So we're going to get the perspective from Dubai, where they're just green light, full steam ahead. How can we bring in trillions? One of my mentors, my mentor, Dan Pena, one of his mentees is actually part of the largest deal in history, which is NEOM, the city of the future, that line, which they're already going bankrupt and bust. But it was the largest deal on record, over $1 trillion. And that's why my mentor calls himself the $1 trillion man, is because cumulatively, all of his mentees have done multiple trillions of dollars worth of deals. But the point being, in Dubai, in the Middle East, in these other jurisdictions, you're seeing them go full steam ahead. All of this investment capital coming in. Meanwhile, after that, I'm going to play a clip from Robbie Mitchnick at BlackRock talking about how they got to get their ducks in a row before they can start moving tens of trillions of dollars in this space. But this is the CEO of Dubai Blockchain Center speaking at Ripple Swell Conference in Dubai. Let's get it.
It's an amazing ecosystem worldwide, and it takes it very seriously that Dubai is actually now at the center of everything that Ripple is doing as well, whether it is locally, regionally, or even internationally. And Ripple Swell being in the UAE is a great testament to that. It's an amazing.
Yeah. And so it's going live. It's a big deal. They set up the Dubai headquarters over there. And like you said, it's just setting up a major base in that Middle East region, which is hungry for a solution outside of the US dollar, which is hungry for a solution to solve their ongoing debt and liquidity crisis that they face, right? And in presents XRP, in comes DLT technology. Before they can move in, though, listen to Robbie Mitchnick, who used to be at Ripple. Now he's head of digital assets for BlackRock. Recall that Robbie Mitchnick is the guy at BlackRock who helped Larry Fink, quote unquote, get it when it comes to Bitcoin and the cryptocurrency space, right? Robbie Mitchnick helped Larry Fink, the CEO, get it. And he's going to be talking here about, how basic this is, how simple it is, how they just needed to understand how to use wallets and how to use blockchain-based settlement here before they can start to move tens of trillions of dollars. Let's listen in.
Before we would move trillions or tens of trillions in assets into this new technology paradigm, that actually first institutions were going to get comfortable with small exposures to crypto itself, understanding wallets and blockchain-based settlement and being comfortable with the risk controls and the infrastructure supporting that. So that's kind of what's happening. You're seeing more institutions get into crypto a little bit, and that I think is helping to pave the way one day for a broad-based transformation in tokenization.
But Rob,
and This is where Ripple steps up now with the custody solutions with Medico and the trust bank. Well, it's not a bank, it's a trust company, which is Standard Custody and Trust, right? Where Ripple can show up as the one-stop shop for all of your digital asset solutions when it comes to custody, when it comes to providing liquidity, treasury management, and then as the utilities get added to the XRP ledger, then Ripple can help their institutional clients utilize, smart contracts, EVM sidechain, and we're going to be tapping in so much coming with oracles, the AMM just getting started up. And so, like I said at the very beginning, I know that we're getting impatient. I know that some folks get triggered by me saying that there's a 2-for-1 special going on with XRP because they want XRP to be at 5-for-1 or 10-for-1, and I'm there too. And I think that we're going to $5-10 this bull run, and I think that we better be getting our ducks in a row. We understand the wallets, we understand how to send crypto around, but I think that what we need to be preparing for is when these institutions do start to come in, where this is going to take some of these underlying assets as far as price wise, and what you're going to do with that money next. Right. So this is what we talk about. I had a fantastic Discord weekly call this morning. Looking forward to dropping our next installment of the business development program. That's going to be dropping tomorrow. So if you guys do want to get access to that, right now I'm including all of our business development content within our Discord membership. So no additional membership, no additional course that you have to buy. It's already included. And right now I'm just going to be dropping those as I build it out. And so take advantage of that in the meantime. And this is why I say it's so important for us to understand the other asset classes like real estate, like private equity, and like the precious metals as well too. We got to make sure that we have a plan here, or even if it's our business too. Because in my opinion, it just confirmed right there by Robbie Mitchnick at BlackRock. They are bringing tens of trillions in. And that's just to get the party started. They are bringing tens of trillions in. What will this do to the underlying assets? I think it does make price go up. We can speculate how high it will go, but when we do achieve some of these targets, what are we going to do next? So let's get that business ready. Let's get our real estate investments ready. Let's get ready with precious metals. Let's get ready for private equity. If you have some other alternative investments you want to drop in the comments down below, let me know what you're doing. But we got to get our plan. We got to get our ducks in a row. They're bringing the money. We're already parked in the assets that they need for this utility, for this infrastructure. Perfectly positioned. Remain patient. I know it's difficult, but keep your eyes on the prize. Focus on the fundamentals, which only continue to get better. If you're getting impatient with price, go back and look at these fundamentals, which on a daily basis we're covering. It just continues to get brighter. Now, with that being said, I'm going to wrap up this session. If you appreciate our updates and what we're doing here, I really do appreciate it when you support us by liking the video, sharing it out far and wide. If you're new here, make sure you subscribe, hit that notification bell so you don't miss any of our updates. And I will see you guys tomorrow with some additional content. God bless you all. Thank you so much. I am your host, Zach Rector. I really appreciate all of the love and support. If you want to support the channel, just remember that you can start by smashing that thumbs up for me, sharing this content far and wide, and everything else is at my website.